Hey guys, welcome back to the IGCSE Accountant. In today's video, we're going to be doing a solved past paper. This is a 045212 Feb March 2022. We have 1 hour for 15 minutes to complete this paper. So let's get started. But we're not going to be putting up with the time. We're just going to be discussing the paper as quick as possible. So let's get started. First question, what is prepared by a bookkeeper? So a bookkeeper is a person who records day-to-day transactions of the business and gives it to the accountant to prepare other accounts and statements such as income statement and SOFP. So we discussed this in our previous video. So firstly, income statement is also a statement. So it's definitely not prepared by a bookkeeper. Next, statement of financial position is also a statement, so it's definitely not prepared by a bookkeeper. Appropriation account is for partnership accounting, so that is also prepared by an accountant. So the option left is cash book, and cash book is usually for day-to-day transactions. It does not include any credit purchases or credit sales. It's only on cash basis. That's why it's called cash book. Moving on to question number 2. Which item is an asset? Okay, so now let's see. We did see what assets are. So assets are anything that the business owns. Okay. So option A, an amount owing by credit customers. So what is an amount owing by credit customers referred to as? It is trade receivables. Okay, and trade receivables are an asset because it is something that the business has to get. And it is a liability for the customer because they have to pay the business. But for business, it's an asset. Next, amount owing to credit suppliers. So anything that the business owes to someone else is trade payables. And this is a liability. Okay. Next, interest accrued on loan. Interest accrued means it is a liability. Accrued means you have not paid yet. You're liable to pay an amount. So obviously this is also a liability for the business. Next, rent received in advance. Rent received. You have to make sure to look into this term received because you're not paying here. Only if you pay it is an asset. When you receive, you're liable to provide the rent service to the customer. So obviously in this case, this is also a liability. So after you classify all these options, now let's go back to the question, which item is an asset? We know it is an amount owing by credit customers. Moving on to question 3. Fatima required additional finance for her business and borrowed funds from Ali. This was deposited into the business bank account. Who is it from? Ali. Who has borrowed it? Fatima. Okay, now let's work this out. So which account will be debited? So which account is the amount deposited into? Business bank account. So in which account is the value increasing? Business bank account. But you need not write business bank account. You can just write bank account is debit. And let's just put a reason column for better understanding. But you need not put this in the answer because amount is increasing. Okay, bank account debit, and whose account is facing a decrease in value? It's Ali's account. So Ali. Since it's a loan, just put loan in the brackets. It's not necessary, but since the option is given, you can go for that. And this account should be credited. Why? Amount is decreasing. So it's option A. Why is it not option B? It's because it is not a trade payable. It it is borrowed funds. Only if it is goods, it is trade payable. It's not this one. And Ali loan, Ali is not borrowing from Fatima. Fatima is borrowing from Ali, so it is not this one. And Ali is again not a trade payable, and trade payable should always be credited. It's never debited. Okay, it should be credited. So it's option A. Now let's move on to question 4. On 1 March, a business owed its suppliers 9,500. During March, the following transactions took place. So they've given us a set of details, and they're asking us how much did the business owe its suppliers on 31 March. So in this case, I would always suggest that you prepare a control account. Whenever you see owed its suppliers, or you see purchased on credit, or checks paid, or discounts received, it's either a purchase ledger control account or a sales ledger control account. In this case, it's purchases. So let's create a purchase ledger control account here. So I'm just going to write PLCA for purchase ledger control account. And I'm not going to go for the date column. I'm just going to put details, dollar, details, dollar. Okay, let's get started. So first, they say that on 1st March, a business owed its suppliers 9,500. So usually for sales ledger control account, it is always an opening debit balance. For purchase ledger control account, it's always an opening credit balance. Unless and until they've specified, this is the general rule. But here they haven't specified, so we should go with the credit balance. So we have to write balance CBD, and it is 9,500. It's 9,500. Okay. Next, goods purchased on credit. This is a credit purchase. So credit purchase is usually credited in the purchase ledger control account. Okay, let's just put a small tick here. Okay, 10,000 is done. Next, goods returned to suppliers. This is purchase return, so it should be debited. So it's high time that you learn the format of the purchase ledger control account. This is 200. Let's put a tick. Checks paid to suppliers. So this is an amount that is paid to the suppliers. So now in purchase ledger control account, you're supposed to debit the bank. 1,900. Check. You should never mention check in any account. Check means it is being withdrawn in a bank. So always write bank. Okay, so now let's move on to the next. Cash discounts received. So discounts received is also debited. Just gonna put this received. It's discount received. I don't have space. So this is 100. So now I've just quickly taken a balance of the debit side and the credit side. The total of the credit side exceeded the total of the debit side. The total of the credit side is 19,500. The total of the debit side is also 19,500 because we have to put a balance. So now let's take the total of the debit side. The total of the debit side is 200 plus 8,900 plus 100, which adds up to 9,200. Okay, now let's take the total of the highest total. So 19,500 minus 9,200. It's 10,300. Okay, so then our answer is C. So it's very easy if you know the format of the purchase ledger control. Now let's move on to the fifth question. Okay, which document from a supplier reduces the amount owed by a customer? So first let's see the relationship between a credit note and a debit note. So for example, a customer buys goods from a supplier and the customer is not satisfied with the goods and wants to return the goods back to the supplier. So when they want to return goods to the supplier, the customer will issue a document called debit note. So the customer is issuing a debit note requesting if they can return these goods. Then the supplier will see the debit note and they will see the kind of fault in the goods, why the customer wants to return the goods. And then if the supplier agrees that they can take back the goods from the customer, the supplier will issue a credit note authorizing that the customer can return the goods. So which document from a supplier reduces the amount owed by a customer? Only when the supplier issues the credit note, the customer can return the goods. So obviously the supplier reduces the amount owed by a customer. So credit note is the answer. Now let's move on to the sixth question. What is recorded in a petty cash book? So a petty cash book is usually used for small cash transactions. Purchase of small value items. Cash purchases and expenses only is not right. All cash transactions will be in the cash book, not in the petty cash book. So you have to make sure to see that this is petty cash book, not cash book. So now let's move on. Okay. Jacob settled the account of Ahmad, a credit supplier. He made the following entries on the credit side of the cash book. Okay. Okay, so in this case, this is a cash book. You have dollar. I'm just gonna go for small date. I'm not gonna write any dates, it's just going to be details. Okay, this is the credit side. So let's put so this is a 3-column cash book. Okay, so the entries here are for Ahmad 5 of discount and cash is none and bank is 195. Okay, which entries did Jacob make on the debit side of Ahmad's account? Okay, so this is on the debit side of Ahmad's account. They're not asking for the cash book. So what will be the entries? It will be bank 195 and discount received 5. So the answer is D. Let's move on to the 8th one. The total of the debit column of a trial balance was more than the total of the credit column. One account balance had been entered in the wrong column. Which one was it? Okay, so now let's first classify which of these are coming on the debit side and which of these are on the credit side. So cash is an asset, debited. Discount received is an income. Anything that is received is to be credited. Drawings is debited. Irrecoverable debts is also debited because it is an expense. Okay, so the total of the debit column of the trial balance was more than the total of the credit column, right? So in this case, the only item that is credited is discount received. So if they had debited that, obviously the debit column of a trial balance would have a higher total when compared to the credit column. So the answer is discount received. Moving on to the 9th question. Devi prepared the following journal entry to correct an error. Cash paid to Samir had been credited to Samuel. So if it had been credited, then obviously the correction entry would have been Samuel account debit and Samir account credit. But then that's not right. Next, moving on to the second option. Cash received from Samuel had been debited to Samir. So if it had been debited to Samir, cash received from Samuel. So it is an income. So then the correct entry should have been, it's not supposed to be debited to Samir. It's supposed to be cash received from Samir is an income. So it would have been bank account debit and Samuel account credit. But that's not the right entry. Let's do the second one. Goods bought from Samir had been credited to Samuel. Okay. Goods bought. Bought means purchase. So then it purchase account debit, and usually when it is bought from a person, Samir account, since it's bought on, then it's Samir account credit. This is not the entry. Let's move on to the last option. Goods sold to Samir had been debited to Samuel. So in this case, Samir account, the entry that should have been made is Samir account debit and sales account credit. But what have they done? Goods sold to Samir had been debited to Samuel. So in this case, you have to debit Samir's account and credit Samuel's account to cancel the entry. So the right answer is B. Now let's look into the 10th question. A suspend account was opened with a credit balance of $840. Okay. A check for $420 received from a customer was debited to his account. Okay, so when it is received, it is an income. So when an income is debited, obviously the debit balance would be greater than the credit balance. So this can be the answer. Let's also look at other options. Discount allowed $420 was debited twice in the discount allowed account. So if this had happened, if it was debited twice, it would have been $840. But then, since it's debited twice in the discount allowed account and discount allowed is an expense, it would have been debited. So the credit balance is not harmed here. Next, goods costing $420 taken by the owner of the business for own use were credited to his drawings account. Okay. So this is goods costing $420. It's obviously credited to the drawings account. Purchase would be debit. And drawings would be credit. Next, rent received $420 was credited twice in the rent receivable account. So if it is credited twice, the credit balance would be greater than the debit balance. So then the suspense account would be opened on the debit balance, not on the credit balance. So obviously it's 10A. Moving on. A trader calculated her profit for the year to be $14,800. The following errors were then discovered. No entry had been made for $200 wages accrued. The insurance expense included a prepayment of $90. Okay, so now let's take the profit, $14,800. No entry had been made for wages accrued. So wages is an expense and expenses reduce profit. So then you have to subtract $200. Insurance expense included a prepayment of $90, which means you've already paid, but again showing it as an expense will further reduce profit. So you have to add the $90. Now let us see the corrected profit. So it's 14,800 minus 200 plus 90. The answer is 14,690. It's option B. Moving on to question number 12. Jack's cash book showed an overdrawn balance at bank of $2,600. So overdrawn means it is a negative balance. Okay. Comparing the cash book with the bank statement, it was discovered that direct debits of $200 had not yet been recorded by Jack. He then updated his cash book. What was the bank balance in his cash book? Updated cash book. So 2,600. This would mean that as direct debits of $200 had not been recorded, direct debit is an expense. So it will further reduce the bank balance because you have to pay more. So you have to subtract 200, which will again give you a balance of negative 2,800, which is an overdrawn. But in this case, since they're asking for cash book, an overdrawn balance is always credited. In the cash book, and it's debited in the bank statement. Okay, now let's move on to question number 13. Which item is debited in a sales ledger control account? Okay. Cash discount, it's not even taken into account. Contra entry, it's also not debited, it's credited. Interest on overdue account, yes. Provision for doubtful debts, not taken into account. So answer is C. Okay, this is since I told you, whenever you see credit suppliers, credit purchase, it's always we've learned that it is a PLCA, purchase ledger control account. So in this case, let's create a purchase ledger control account. Okay, so first one, what is the data that is given to us? Balance owing to credit suppliers. We already learned that a purchase ledger control account always has a credit balance. So balance BD is 420. Let's put a small tick. Credit purchases is always credited. 590. Returns to credit suppliers is purchase return 110. Checks paid to credit suppliers, it's again bank, which is debited 291. Next is discount received from credit suppliers. We just put this received. I don't have adequate space, so I'm just writing this received. That is $9. Okay, then we have interest charged by a credit supplier. That is $5. Okay, now let's quickly take the totals. It is more likely that the credit side is greater than the debit side. So 420 plus 590 plus 5 gives a total of 1015. Okay, and we have to subtract 110 minus 291 minus 9 from that total, which is 605. So you put balance CD 6051015. So 110, 291, 9 plus 605. It's always good to double check your answers. Okay, so 605, the answer is B. Next. Which item should be treated as a capital expenditure? Capital expenditure is a purchase of any non-current asset. Okay, cost of repairing is an expense. Purchase of new computer for resale, this is anything that the business is selling to other customers, which is not capital expenditure. Cost of building an office extension, yes. The annual depreciation is not capital expenditure. Okay, 16th one, on the last day of the financial year, Khalid purchased office fittings, $900. This was incorrectly recorded as office expenses of $90. Khalid does not charge depreciation in the year of purchase, so it means no other expense is associated with the purchase of office fittings. No depreciation. What was the effect on the profit for the year? Since they're telling no depreciation is also provided, purchasing an asset will never understate the profit, but in this case they have mentioned it as $90 as expenses for office expenses. So the profit for the year is understated by $90. Moving on, we have Agi is a trader. She uses the following methods of depreciation for different types of non-current assets. Straight line 20% per annum, reducing balance 25% per annum, reevaluation. Okay, on 1st January year 1, Agi purchased small items of equipment costing a total of $2,400 and fittings costing $8,000. On 31st December year 2, year 1, year 2, Agi estimated that the equipment was worth 70% of its original cost. The statement of financial position showed a net book value of equipment of 1,680 and fittings of 4,800. And the question is, which depreciation methods has Agi used? Okay. First, the equipment is purchased for 2400, and since you are giving the net book value, it means that they're using reevaluation because no other accumulated depreciation information is given for equipment. So it is not A, it is not D, any two of these. Okay, moving on. They're asking for fittings. Okay, let's see for fittings. They're saying that they use 20% per annum for straight line. So first let's check with straight line. So $8,000 into 20%. 8,000 into 20% gives 1,600. Okay, so this is for the first year. So the first year depreciation is for year 1 is $1,600, and they are telling that the statement of financial position is shown after on 31st December year 2. So you have to do 1,600 into 2, which is 3,200. So 8,000 minus 3,200, which is the accumulated depreciation, gives a net book value, which is 4,800. So we know that it is straight line method. Okay, let's move on. Abio prepares financial statements to 31st December each year. Bought machinery for $40,000 on 1st January year 1. He charges depreciation on machinery at 20% per annum using the reducing balance method. Depreciation is charged in the year of purchase but not in the year of disposal. On 1st January year 3, the machinery was sold for $22,000, which journal entry records the profit or loss on disposal of the machinery. Okay, let's look into this. So let's first calculate the depreciation. So 40,000 into 20% is equal to 8,000. 40,000 minus 8,000 is equal to 32,000. Okay, this is for year 1. Just gonna put year 1 here. 32,000 into 20% is again equal to 6,400. 32,000 minus 6,400 is 25,600. Okay, so they are also telling that depreciation is charged in the year of purchase but not in the year of disposal. So in this case, what you do, you have to do 22,000 minus 25,600, which is minus 3,600, which means it's a loss. So in this case, the journal entry would be income statement debit and disposal of machinery credit. So when there's a loss, disposal of machinery will be credited. When there's a profit, it will be debited. Moving on. Why would a business record the amount owing by a credit customer as an irrecoverable debt? The customer has gone out of business. Yes. Customer has liquidity problems. No. Customer is making a loss. No. The customer is not satisfied with the goods. No. Usually they go bankrupt or out of business. Next, ANGI maintains a provision for doubtful debts at 5% of trade payables at the end of each financial year. At the start of the financial year, the trade receivables were 2,000. At the end of the financial year, the trade receivables are 4,500. Which entry would be made in the income statement for the financial year? Okay, let's see. First is the PDD, the provision for doubtful debts at the start of the year, which is 2,000 into 5%, which is equal to 100. And at the end of the year, 4,500 into 5% is equal to 225. And the difference is 125. Okay, the difference. 225 minus 100 is equal to 125. Okay, so then we have to put 125 as an expense because it has increased. Next, 21st question. Which businesses do not prepare a trading account section of an income statement? So usually all businesses who provide products, goods, usually have a trading account section because they do purchase certain raw materials. All of that is put into purchases. But when it comes to a service business, they don't have anything to purchase. They only get money and provide the service to the respective consumers. So in this case, it is a furniture store. Let's classify. Furniture store is not a service business. Insurance company is. News agent is not. Toy shop is also not. Window cleaner, yes. So 2 and 5. Moving on. Now let's look into question 22. A business provided the following information: current assets 25,000, current liabilities 12,000, non-current assets 18,000, non-current liabilities 21,000. What was the capital of the business? So what is the formula of capital as per the accounting equation that we have learned? Capital is equal to assets minus liabilities. So in this case, the total assets is the total of this, and total of liabilities is total of this one and this one. So the total assets is 25,000 plus 18,000, which is 43,000. Total of liabilities is 12,000 plus 21,000, which is 33,000. So let's subtract it. 43,000 minus 33,000, which gives a difference of 10,000. What is the capital? Very easy question. 10,000. Moving on. A trader bought a machine. So now let's look into the 23rd question. A trader bought a machine for use in business. He paid in part of the cost in cash and agreed to pay the remaining in 15 months' time. In addition to the non-current assets, which items in the statement of financial position will increase as a result of this transaction? Okay, so his current assets will not have any will not be affected at all. So the answer is either C or D. Current liabilities, no, because they have mentioned 15 months time, so it is more than a year, so it is not current liability, and non-current liability, yes. So answer is D. Question 24, what is purpose of partnership appropriation account? To calculate partner salaries, no. Record partners drawings, not at all. To show the distribution of profits between partners, yes. To show the movement on partners capital account, no. Answer is C. Moving on, question 25. James is a partner in a business. He made a loan to the business and received loan interest. What is the double entry in the books of the partnership for the loan interest James has received? So in the appropriation account, interest on loan is subtracted in the income statement but not in the appropriation account. So the correct answer would be interest on loan account and bank account would be credited. This can be seen, you can check this out in your respective textbooks. We do have 3 textbooks for the IGCSE coursework. One is Collins, the second one is Hodder, and the third one is Cambridge. I usually suggest that students use the Cambridge book because it's very easy to learn from and refer to. Moving on to question 26. A limited company whose capital consisted of ordinary shares ceased trading and was not able to pay its debts. Which statement is correct? Shareholders would have to pay a proportion of the debt based on the number of shares owned. No, the main advantage to shareholders of having shares in a limited company is that they have limited liability. Shareholders would have to pay a proportion of the debt. No. Based on the value of shares, no, not at all. Shareholders would have to sell their personal possessions to pay the debts of the company. No. Shareholders would lose the money that was paid when the shares were first purchased. Yes. 26 is D. Moving on. A limited company was formed on 1st June 2021. On that date, the company issued $500,000 one shares. Shareholders were asked to pay 60% of the cost immediately, with the remainder being payable by 1st June 2022. By 1st August 2021, all shareholders had paid what was due at that date. So in this case, the answer would be B. So firstly, because the paid up share capital is also 300,000, called up share capital is also 300,000, because we're being asked to pay 60% of 500,000. Moving on, there are 120 members of a sports club. The annual subscription is $60. At the beginning of the year, no members had paid in advance. No members had subscriptions outstanding. At the end of the year, 7 members had not paid. 3 members had paid in advance. Which amount was shown for subscriptions in the income and expenditure account? Okay, let's look at it. First, let's create a subscriptions account. Okay. So subscriptions account is more or less like a accruals and prepayments account that we create. So details, $, details, $. Let's get started. Okay. So they do say that at the beginning of the year, no members, so no balances. And at the end of the year, 7 members had not paid, 3 members had paid in advance. So first, in this case, the bank value would be the amount is what we have to find. So 120 into 60, any amount that should be received should be in the income and expenditure account. So then we have to do 120 into 60. So let's calculate that quickly. 120 into 60 is 7,200. So in this case, you don't even have to prepare a subscriptions account because they're only asking for an income and expenditure account. Answer is C. 29. What is a manufacturing account? Cost of raw materials consumed. What is shown in a manufacturing account? Cost of raw materials consumed, yes. Purchases of finished goods, no. It's shown in the income statement. Cost of production, yes. Cost of sales, no. Income statement. So 1 and 3 only. Moving on to question 30. Tarek produced a statement of affairs at 31st December year 1 and 31st December year 2. During year 2, his long-term loan increased by 3,000 and his net current assets decreased by 1,000. Depreciation for the year was $500. How much did the total of Tariq's capital decrease by? Okay. So first, we do know that his depreciation for the year was 500, so we subtract 500, and the net current assets also decreased by 1,000, so we subtract the two, we have 1,500. Whatever has decreased, we've subtracted that. Okay, next 4,500 Okay, so now let's look into this. 1,500 plus 3,000, which is the amount it increased by, minus 3,000, because it is a long-term loan which increased, so it's minus 3,000 plus minus 1,000. Minus 3,000 minus 1,500 gives 4,500, and when you subtract that again you get 1,500. So the answer is 4,500 because it is minus 3,000 minus 1,500, which gives a difference of 4,500. Moving on to question 31. Gross profit margin, the formula is gross profit divided by revenue into 100. 2,900 divided by 12,800 into 100. This is equal to 22.66%. Okay, moving on to question 32. In this case, what we're going to be doing is that the formula for calculating trade payables turnover is trade payables divided by credit purchases divided by credit purchases into 365. So in this case, trade payables are 8,000 divided by 133,000. This is 150,000. How did we get 133,000? Is that it is 155,000 minus 17,000 into 365 would give you 22 days and rounded off to the nearest day. Okay, moving on. A trader decided to reduce her level of inventory in order to reduce the storage costs. Sales quantity and selling price were not affected. How did this affect the profit for the year and the rate of inventory turnover? Okay, profit for the year would have been increased and the rate of inventory turnover would have increased as well. So answer is B. Next, Azim and Bashir are both sole traders. They provided the following information. What was Azim's return on capital employed? Okay, so the return on capital employed after calculating for Azim is 20%. Please do calculate it because I have my calculations done. And for Bashir, it is 40%. This is just for you to verify your answers. So the correct answer is B because it is half of Bashir. And last question, Stephanie's major competitor has invested in new machine for making goods more cheaply. Stephanie knows that this will affect her sales but did not record this in her accounting records. Which accounting principle is Stephanie applying? Money measurement. Because you are not supposed to include anything that is not in monetary terms in your accounting records, and that is the money measurement principle. But let's also review the other principles in our further videos. Thank you.